Hello, welcome back. It's very nice to have you again. I hope you had a inspiring day yesterday with our first day of our FERMA Talks. I'm delighted to welcome you back here live to the studio in Brussels for the second day of what I hope will prove a very interesting and inspiring debate. Today we're going to be focusing on the financing of risks. This morning is dedicated to the state of play and future trends in the insurance market. Both risk managers and leaders of Europe's insurance industry will share with us their views and answer the questions that we have for them. And then this afternoon, we're going to be focusing more specifically on how organizations can build financial resilience, the theme that we talked about so much yesterday, to all the disruptions that we are going through. So I'm delighted to be, first of all, with two very experienced risk managers. We have Carlo Cosimi, buongiorno. You are the head of corporate insurance and risk financing for Saipem, which is a global engineering and drilling company. You're also the president of ANRA, the Italian Risk Management Association. Thank you very much for being with us. And buenos dias a usted, Mario Ramirez Ortuzar. You are risk and assets manager at Exolum, Europe's leading logistics company for liquid products and one of the largest in the world. And you are also vice president of AGERS, the Spanish Risk Management Association. So, questions to both of you. It's obviously the insurance renewal period at the moment. What are the situations that you're facing? What are the main issues? And how are you dealing with this in terms of management?
The situation that we are facing is very complex and challenging because, as you know, hard market arrived 2 years ago. And hard market means, in particular, with less insurance capacity available, more requests to increase deductible, potential more litigation for claims, tough negotiation, and strong rate increase. And this market situation, hard market, hit all lines of insurance coverages. But in particular, one more than others. In particular, I mentioned two D&O liabilities policies or cyber risk. We saw that, for instance, in the D&O policy renewal was asked for triple-digit increase. Let me say it was impressive, and also request for reduction of capacity available. In particular, the market standing was to maintain a position of offering coverages in the excess layer, but lacking support in the bottom layer of the risk. So put us as a risk manager in a very difficult situation to manage this kind of risk.
Mario, would your analysis presumably be more or less the same?
Very similar. The truth is that, first of all, thank you to FERMA for giving us the opportunity to share our experience. We are here not only representing ourselves, we are also representing our associations, our colleagues, and to be honest, we need to say that the situation is very, very tough. We, in our experience, for example, we are dealing with an insurance program for a long time. We've been doing things correctly, as insurers like. We keep control our frequency. We manage our risk correctly. We share our measures and our mitigation measures with them every year. and we keep a profitable account for them. And with this new trend, everything is changed. And it's very difficult for us to explain internally how we deal with this situation of continuous increasing of the premiums. And what we've done in our case is change our strategy. Now, for example, Carlo mentioned the increases of deductible. I can also mention the that we are buying less limits in certain coverage. And we're in a situation now where we are not going to pay any price for certain limits. So we need to analyze again what is exactly the limit that we need for each coverage, and that's what we're going to transfer to the market.
Is it the same analysis for you, Carlo? How does this affect your internal discussions with your CFO? I mentioned that they're not easy, and are you having to change strategy?
Yes, absolutely yes. We are involving in a very strong discussion internally, not only with the CFO, but involving all the top management of my group, from the CEO to the advisory board, to the control, audit, and risk control committee, and all the different, let me say, function that this discussion, the result of this discussion was to increase the support of our captive. We ran a captive since 14 years ago. Is their insurance captive, and the top management asked me to increase their support. For instance, next renewal we will pass from 20 million euros for each and every loss limit to write in the captive 30 million euros each and every loss. So is our reaction in order to compensate, let me say, the request for this kind of increase of rates.
Is this the kind of thing that's happening with you too, Mario?
Yes, we went to the last renewal analyzing how to increase our deductibles. We didn't achieve big reductions from the market, so we keep them as they are for this year. But our renewal is in July, so we have time during this year to analyze again what is our risk appetite, and it's a very amazing discussion that we are having internally to analyze every risk, what capacity do we have internally to retain that portion of risk by our own selves. And what we're figuring out is that we need to self-retain a very big amount of capital to really achieve reductions from the market, and again, to send the market a message that we are sharing the risk with them. And once you do this, you have a lot of alternatives, as Carlo mentioned, with captives, but you have other alternatives to deal in the alternative risk transfer market. You have different options like insurance products or just your self-retention to deal with it. But we are worried from our associations because we are large companies and we are able to deal with this situation. We can pay higher premiums, but we're very worried about the medium and small size companies because we saw that in some cases they are not buying insurance anymore for certain risks because they are not able to pay the premiums that the market is asking for them. And they probably don't have this capacity or these tools to self-retain more or to know. So that's one of our principal worries.
Okay, so difficult situation, obviously. But can I ask you to maybe stress something positive which has come out of the recent situation? Are you seeing any positive takeaways?
To me, it's very difficult to find a positive key development in this kind of situation. Let me say that the change from soft to hard market was extremely fast and boosted by pandemic crisis. That, I believe, put us as a risk manager in a very difficult situation. And we were completely surprised because after a lot of years of soft market, we were, let me say, in a sort of comfort zone as a risk manager, okay, in negotiating for insurance coverages. By the way, the situation changed so fast that probably the positive, this is the opportunity of this situation for us as a risk manager, is to recover our position in the company, our visibility, in order to provide, it's the opportunity to show our professionalism, our creativity, our ability to manage the risk in this kind of situation. But it's not easy. It's not easy, but I believe that as a risk manager, we will sort out of this situation more reinforced and with more visibility in our companies.
Un poco de optimismo español, por favor.
Well, I used to see always the optimistic point of view of the situation. And in this case, I think it's a good opportunity to reinforce our relation with the insurance market. As Carlo mentioned, it's an opportunity for risk management because we would need to deal by our own selves with more risk now. And for example, in our company, in the soft market, we used to do around 4 or 5 site visits with insurers to our facilities all around the world. And now we are increasing this number of site visits. Now with the hard market, all the insurers want to follow us in the site visits. In the soft market, they came 1 or 2 of them only. But now they all want to follow us. So that's a good message because it's an opportunity internally for us to show how we deal with the risk internally, what strengths we have. And again, I think we're in a situation now in this market where Carlo is not exactly in the same in the sector that my company is in. But the truth is that we are competitors now. we are trying to get the low capacity that the market is offering us, and we need to show that we are better than the other client. We need to show the insurer that I'm doing things better than others. So it's a good opportunity to also internally in our organizations to talk more about risk management and to increase all these mitigation measures.
Just a question that occurs to me when I'm listening to you. Is this a major crisis, or is it a crisis? We've been through the financial crisis and so forth. Is this last one a change of paradigm totally, or is it just another crisis we have to deal with? To what extent is this a major crisis?
Yes, in our sector we are passing through a transition of the business model because we know that. Our industry is looking to the renewable. We are in what is called energy transition. As contractor companies in this industry, we are also review our business model in order to, in our cases, to be more focused in the renewable, in the hydrogen technologies, in the wind farm technologies, in order to propose more solution to our client. That our client are the oil, or let's say oil in the past, now energy companies, but also maintaining our presence in providing services in the traditional energy sector like the oil. So we are in the middle of this transition, and of course we are looking to this sort out from the crisis of the oil price barrel that we had a few years ago.
So for you, is this a total change of paradigm, or is it one crisis after another?
In terms of the reaction of the insurance market is a new situation because we came from probably almost 20 years of soft market, 15, 20 years of soft market, and now we are facing a completely new situation. In my case, I didn't have an experience before, and I've been working in this company for 13 years. And I never face a situation like this. But again, I think if you're doing things correctly along the time, you will receive. And again, my worries are for the companies that do not have the support of a risk management area to deal with this situation.
Now, I know that IOPA, the European Insurance Authority, is looking to open insurance. Maybe you would like to comment on that. We were talking about the sharing of data yesterday, so it'd be interesting to hear your point of view of the sharing of data between the insurer and insured. What can you do to make sure that insurers and brokers increase data sharing?
Well,
This is very nice to me because the opportunity to share data with the broker and the insurers is very good. Very recently we had a very good experience as ARRA for the Lucy project. We were requested to collect data from brokers about cyber risk, and we success in this collection. So I believe it was a very good experience. But also let me say that
can I just say, what made it good? Was the openness of it?
Yeah, it was open. Yeah,
And that's new.
The brokers, Italian brokers, respond very well to our request to provide data.
And that's new.
Yeah.
It's a new attitude.
Yeah, exactly. And but to me, it's very important also the role of the national insurance supervisor in order to push broker and the insurers to share their data, and also the role of the national insurance supervisor will be also to collect and to release to us, to risk manager, this kind of data.
Push in what way? Can I just ask you, how can they push? How can they make the sharing more easy?
But it's important that this push is made by the supervisor, not by of course, by client. And this will be very important because the only level of critical point to me is the level of details of this data. Because this data have to be managed with attention in order to avoid to breach compliance or confidentiality of this data. So,
are you willing to give a concrete example of what kind of thing we're talking about?
It's very important to find the right level of detail that you can share this kind of information, because otherwise you risk to be in breach of compliance or confidentiality.
Well, I'm not very optimistic in this data sharing. I think FERMA is doing very well with EIOPA trying to push insurers to share this data, because of course it's going to be good for all of us. But I can imagine an insurer that has been working in LATAM, investing and paying claims for 50 years, and you're asking them now to share all that knowledge, because that data is knowledge for them, with their competitors. So it seems quite difficult for me, and it's similar with brokers. It's a different situation that we face, for example, if we need to build a new facility somewhere. Of course, we're going to receive the advice from brokers and from insurers to at least let you know where not to build that. Don't do it close to a volcano. Don't do it in certain places, or where for example, the cat-nat risk is higher. But again, brokers sharing data between each other, brokers are trying to become as big as they can every year. So that means that they want to hold more information, more data, and I'm not very optimistic about this sharing of data between each other. With us, yes.
But we're living in a world where we all share data. Like, the amount of data that's on my phone that I share without even knowing when I press on a cookie, data gets shared, isn't it? And it's going to get more and more shared, whatever, even if brokers don't want to.
Yes, probably they would need to decide what type of data they can share and what not, because part of that data is their knowledge. So the reason why we decide to go with a broker or the other broker in certain circumstances or with certain type of risks is due to the knowledge that they have in that sector. So if they start sharing of that knowledge, it's not going to be a competition between all of them. So no, I don't know. I'm not very. I don't have a very clear opinion in terms of if they are going to finally share the data. We can ask them later.
Okay, I'm sure there'll be some of the questions that will come up after.
I will add more, and to us will be very important to have this kind of information, because also could help us in our risk management process, because all data is the fuel of our activity. So we know very well our internal data of my group, but it would be very important to know the data of my industry, for instance, or more, in order to focus our strategy on risk management in a proper way between the retention level or the risk transfer level.
Yes, and I want to add here is important what you mentioned, because I think that the position of the national associations and of the federation can be crucial here, because we all have a lot of data. We know what part of the data we can share. We have no problem in sharing our knowledge in risk management and in terms of loss record with other colleagues in the association. So I think that definitely our associations must push hard to collect this data and to share it between all of us.
Now, one of the themes we talked about a lot yesterday, and obviously a theme that everybody's talking about, is sustainability. So I'd like to ask your point of view on this. How do you see that the impact of the sustainable agenda from the insurance supervisors affecting corporate clients? We talked about this quite a lot yesterday, but it would be very interesting to have your point of view.
My group is ranked as a leader in the Dow Jones Sustainability Index since a lot of years. And we invested a lot in sustainability. And but all the times that I met my board member or my directors, they asked to me, what are doing the insurance market in order to recognize us as sustainable, really sustainable, and apply proper coverages, take into consideration our efforts that we put in place. And it's difficult to me to explain what they are doing, in particular right now in the hard market situation. So to me, it's today unclear which kind of information I have to provide to broker or to insurer in order to be considered or to be assessed as sustainable client.
What are the reasons
and which
for this
benefits?
lack of clarity? Why is it unclear? What are the reasons?
It's unclear because I provide all the set of the information to the broker for renewal, okay? But they don't ask to me particular focus on sustainability process, how we are sustainable, what sustainable process, what sustainable targets we have in the strategy of my group. The question that the board director asked to me is, which benefits can you bring home? Because if you look at the financial side, there are some line of credits available that reserved to sustainable client in the financial sector. In the insurance sector, at the moment, there is no particular line or consideration of your sustainability level that you have. So this is a question that I pose also to other colleagues during this morning.
Maria?
I love this question because I was listening yesterday to everything, and it seems very nice. It seems in a very high level, but from the perspective of a risk manager, we don't see, at the moment, we haven't seen anything. In terms of reduction of premium for a sustainable business model. And
nothing at all?
Not in our case. And in our case, it's important because we are in an industry, for example, we are managing 6,000 kilometers of pipelines moving hydrocarbons in Europe. And we are starting new business to be prepared to the reaction of the demand when the people start not consuming more hydrocarbon, to be sure that we can maintain the profitability of the company. So we're investing a lot of money in doing all these things. And we are the way the industry is looking at us is like, okay, those are the guys that are polluting the planet. And the truth is that our pipeline is moving hydrocarbons all over Europe and is allowing the people to have their heat at home, to drive their cars, and we cannot stop from one day to the other. So all the oil and gas industry is in a huge transition, and we need a lot of support from banks and also from insurers to deal with this transition. If the solution for the market is, okay, we are only going to underwrite green business and we don't want any other business anymore, we are not going to be able to invest that money for the transition. And I have a good example that is happening in my company. We transport and storage, for example, in the UK, the 50% of the kerosene that is consumed, and in Spain, the 85% of the kerosene. And we're introducing now a new type of kerosene in a 10% that is a sustainable aviation fuel, SAF it's called. And I want to ask, for example, insurers or bankers, the price of this product is much higher than the other one. So we need support to introduce this product in the business. Are you going to give me a reduction in terms of rates, for example, to the airports where I am dealing with this sustainable aviation fuel? Because that's a good way of pushing our industry to accelerate this transition. But at the moment, we haven't seen anything. The only thing we receive is a lot of messages everywhere that our board are reading, and everybody is very worried about what's happening with this sustainability topic, that all the insurance market is saying that they're going to change, they're going to invest in sustainability models. So the first question is, what is a sustainable model for you? Is 90% kerosene and 10% sustainable kerosene, that's a sustainable model? Because if you invest in that, we are going to be able to put 20%, 30%, and to change the business model. If we don't receive some support, then it's not profitable. So we are going to spend more time to deal with this transition.
Can I ask you a question as a consumer and also a journalist? You say transition, energy transition. It seems at the moment when you watch the news, I was watching the news in my hotel room like everybody here this morning, energy prices, it's not so much transition, but panic. It's, isn't it, doesn't that make it, is that just a temporary blip? Or is it something, the volatility of energy prices and the energy markets, is that something we're going to have to live with just for a few weeks, or is it months, or?
Well, there's a target.
Difficult to say.
Yeah, it's
we need
target,
to have a crystal ball. By the way, I believe that probably this is a component. We are sorting out from a pandemic crisis that stopped all the economy. Now, my impression is now the restart is fast, too fast, in order to.
Too fast.
Exactly, in order, because the same example that you are doing about the price of the oil, also commodities involved. Increased volatile price of steel, copper, aluminium, everything. All is another issue that we have to face right now as a risk manager. It is the supply chain risk, in particular, also the price of commodities, let me say. So this is a general situation that we are facing in which the cost of energy and raw material is increased a lot.
Unpredictable.
Absolutely unpredictable. But we are being pushed by regulator. You've seen in the city where we are based in Madrid, you can not move certain type of vehicles in the center town. So things are changing. They want to change. They want to avoid totally all the hydrocarbon cars from the cities in 20 years or 30 years. I don't know exactly, but it's a very challenge target to deal with if we don't receive support to do all this transition, because we cannot change from one day to the other. That's clear. To give you an example of my industry, the oil and gas industry, I take my kids to school every morning, and my kids are asking me why I'm not working in Tesla instead of a company that is moving hydrocarbons. They don't like it at all. So this type of message, please, let's send them correctly, because my kids are a little crazy with this situation. But I explained them, for example, we went to Oman in 2014, and we built 250 kilometers pipeline connecting two refineries with a big storage facility. And we avoid from the roads of that country thousands of trucks that they were moving and polluting every day and increasing the traffic. And so there are other ways of being sustainable and to deal with your stakeholders other than solar plants. That is the topic that everybody's looking at now.
Right, well, we have 8 minutes left. I'm going to give you 4 minutes each, because I think it'd be quite interesting to have your crystal ball predictions, both for the medium and the long term, about how you see the insurance market evolving. I know it's very difficult, but I mean, that's what you're here for. You know better than some of us anyway. So what's your prediction?
I believe that the insurance market should evolve in order to offer more tailor-made solution to us. Tailor-made solution means also based on traditional risk transfer or made on alternative risk transfer. Because we are facing new emerging risks, like reputational risk, like cyber risk, for which today we have not, let me say, a standard wording form, but we can see different wording from different insurers. And also we need to face new solution for supply chain risks. Because I just mentioned before that one is the problem about the price of the commodity. And I have to say that some insurers are supporting also to find a solution to contain, to protect this volatility, mirroring some financial derivatives products, let me say, but offered as the insurance solution. So you can also to buy in the market insurance solution in order to protect the risk volatilities of commodities. But also we need, as a contractor as we are, we need a solution in order to reduce economical, for instance, to reduce economical impact for delay in delivery of our vendors. Because, you know, there are some delay that could impact dramatically in our project in order to slow down of our activity or stop our activity. So today we are not able to find a proper solution, tailor-made solution in order to reduce this impact if happened in terms of supply chain channel.
In my case, I think that the traditional insurance market is going to change this trend in a few years, probably. As soon as they return to benefits, they will start to compete again for more capacity in the market. So it's something that is going to happen sooner or less. Probably we won't face again a soft market as we had in the past, that we don't like too much, that's to be honest, because you cannot show internally in your organization what you are doing if every time you go to the market they give you a reduction of 20% without showing anything sometimes. Not always, but that was something that happened 3 or 4 years ago or 5 years ago. And so in that point, I think that things are going to change. What I'm very worried, and I think we are all, is about the new challenge or the new risks that we are facing. Of course, pandemic is something that insurers cannot deal with alone, probably in a mix between private insurers and the public regulator. Together, they can look for a solution for this type of crisis. But the other big hole that we're facing is the cyber risk. I honestly think that in the future it's going to be very difficult for the insurance market to deal with this risk. So we need internally to look for other solutions probably and have the support from brokers and insurers to deal with it. But I'm sure that in several years the risk is going to become so huge that we won't be able to deal with it.
One final question for me, because I've been listening, I'm quite interested in your point of view on this, because you were talking about your children. Is the profile of risk managers going to change with the new generation, with young people? Because their concerns are so different than other generations, especially about the environment. Is the profile of risk managers going to change quickly so that the whole profession changes?
Yes, our professional is changing in the last 2 decades, increased a lot, improved in terms of, as a risk manager, my experience, I was a risk manager that I didn't study for risk manager. I'm a generation of learning by doing risk manager. Now the new generation has the opportunity to have a more training path at university or master in order to increase their professionalism at a higher level. So I believe that our is a very good future for our professional, because risk manager also increases from the bottom to the top of the chair of the bottom level. Is a very good opportunity for the future.
Los jóvenes españoles.
Yes, I think exactly the same as Carlo. I think education now is completely different in terms of risk management. FERMA and the national associations are investing a lot in time and resources in this education model. So now you can start to work with us in our teams with a lot of courses being done and a lot of knowledge that we need in the past several years to achieve. So I think it's going to change the model. And again, when you mean sustainable or in terms of the new generation that is coming, I think we need to send them the correct message about what is the current industry, what is the transition that needs to be done, and of course, let's do it as fast as we can, but supporting all the steps. Don't jump from one step to the other, because we are probably going to retard the transition if we don't do it correctly.
Perfecto. Gracias. Grazie. Thank you very much indeed. That's very interesting. Thank you for telling us some of the concerns you have and your analysis of the market. I'm sure it's interested the audience a lot. We're now going to have the round table about the insurance market after the pandemic. I think you're going to listen to it, but afterwards I'm going to ask you to come back here. But I think that's probably best if you go back and so you can actually see what's going on. But thank you. I'm sure here in the audience we can give speakers a round of applause. Thank you very much to Carlo and Mario. Gracias y gracias a ustedes, and see you in a minute. So I'm delighted to welcome you back here to our roundtable. We're still live from Brussels. Delighted to have you with us, and I'm very happy to be surrounded with a panel of some of Europe's leaders from the insurance industry. Let me introduce you all. We have Henning Hagen. You are a member of the Board of Management and Chief Regions and Markets Officer at Allianz Global Corporates and Specialty SE. We have Paul Knowles. Hello, you are the head of Marsh Specialty for Continental Europe and chairman of Marsh NVSA, the UK branch that handles the Europe Economic Area risks placed into the London markets. Loïc Le Dréau. Bonjour. Yes. Pardon, Loïc, c'est vous, is the managing director of the FM Global Southern Europe. You oversee the regional operations and you're responsible for the FM Global's markets position in the region. Edgar Puss, Dr. Edgar Puss, you are the CEO of HDI Global SE. You've gained the reputation of being a man of action at HDI Global SE, and with your clear vision and not shying away from the consequent decision-making needed for its realization. That's what I've been told about you. Delighted to have you. And also, last but not least, Xavier Véry, your CEO of AXA XL's APAC and Europe Business Unit, and since joining AXA in 1996, you've been involved in several of the group's strategic initiatives in Europe, the Middle East, and Asia. You can actually find out, we have all your bios on the website, so if you want to look and learn a lot more about a very prestigious guest, feel free on the website. I've just given you a little taste of some of the talents we have around the table. I think I'm going to start with you, Loïc. Could you tell us the theme of our debate today is how has the pandemic changed businesses' perception of risk in general, and what are the implications as you see them? We've just been talking about them for risk managers.
Yeah, firstly, it's great to be here in person and to be speaking in real life. It's quite new. It's the first time for me since almost 2 years. I think we are living through the most transformative time we had for the insurance and the risk management industry that most of us has ever experienced. If we look at 2019, it was only 22 months ago, and when we think about it, we already feel like it was another time. The pandemic, I think, has changed our perception of risk. It exposed vulnerabilities in organization, and it makes risks more tangible. Leaders in the organization are thinking and working to manage this new systemic risk, and it's quite challenging, but I think it makes risk management even more complicated, but also more exciting.
Exciting. It's
yes.
One positive to take away from it.
I think so. And I believe, as our colleagues, risk managers said before, it's also a real opportunity for the risk managers to be part of the discussions that are taking place at the heart of the organization, at the board level and C-level. And especially when we think about this systemic risk, they are even more interconnected. Cyber, supply chain, climate change, everything is interconnected, and it makes the challenge even more complex for us as insurers and for the risk managers. I think that at FM Global we can help give the risk manager the information and the data that they will need to build the story internally in the organizations. Risk managers, they need data. They need data, and they need the insight from the data in order to tell the story that they have to tell to their board and to be more relevant in their organizations. The way we do it with FM Global, we have our field engineer, for example. They are doing 100,000 site visits per year. And we collect about 70 million of individual data points. And a big part of our job is to ensure that the data that were collected are relevant for the risk managers and are available to them. And I think most importantly, they are collected in a consistent fashion in order to have quality data.
What do you mean by consistent fashion?
It means that when we collect the data, for example, in France, in Belgium, or in Latin America, we collect the same type of data with the same methodology in order to have data and information which are compelling, consistent and compelling, from which we can develop a compelling story. If we think about climate change, as climate change progresses, the impact of it will have an impact, an increasing impact on the severity and the frequency of natural disasters. And as insurer and also as risk managers, we need to help, and insure specifically, we need to help our clients to understand what are their climate risks and how we can help them to build client resilience. FM Global is an active member of the scientific community. We are working and we are use the science that we find behind the client resilience in order to help clients to find solutions. If we speak a little bit about cyber, the pandemic has accelerated the fact that we are living every day in a most digital world. And also it has a great impact, for example, and during the pandemic it helped organizations to meet the needs of their clients. But we see also a trend that is not so positive is cybercrime. And there is a trend also, an evolution in the type of cyber attack and cyber crimes that we see. Cyber attacks are becoming more and more physical in threat. And if we think about the attack that the water system in Florida had to suffer a few months ago, it's visible that a cyber attack, which was in our mind before purely on the intellectual side, is moving towards more physical. And it's one of the reasons is everywhere in all industry, but also in every hotel, we find what we call industrial control systems. And these industrial control systems are more and more connected and intelligent. And I think it's an example where the technology is available before the safety technology is in place. And I think it's an interesting warning for us as a risk management community, and especially for the risk manager, to be always on the front foot to manage this type of risk. As a conclusion about this quick overview, COVID-19 has resulted in an unprecedented change in our way of living. It has thrown a new risk, but also it's a great opportunity for the risk managers. And I think risk managers, they must adapt to this new world. And as insurer, our mission is to help them adapt.
Okay, right, thank you for that general overview. Yeah. I'm sure you all have things you want to say about that. Start with that. I'm going to come to Paul first of all, because what's interesting from your point of view is perhaps tell us about the role of the broker in having to deal with this situation.
Yeah, it's an interesting one, and I think obviously the title of today is post-COVID, and I think we have to acknowledge that we're not actually post-COVID yet. We're sort of still navigating through an awful lot of the challenges, and obviously FERMA, a lot of the the members of FERMA, their organizations are global, and their colleagues, communities are still sort of struggling with the impact. And
to tell you, there's a new variant that's come up in the news this morning, so we're certainly not post-COVID yet.
Yeah, and it's an interesting sort of moment that we've seen the dynamics of the market. We're already seeing the market pre-COVID going into a transitioning phase, and that was just accelerated when we were in when the COVID pandemic really sort of hit in that first quarter of 2020. And as Carlo and Mario sort of said, it became the toughest trading conditions we've seen in a long time. And certainly I look back on my career, and it was really probably post 9/11 was the last sort of real sort of trading environment of similar that we saw last year. But the interesting thing with post 9/11, it was around a particular individual risk. I think one of the things we've seen in the sort of current environment is that we're now sort of debating and looking at much broader risks, looking at cyber, looking at ESG, looking at the pandemic, looking at things like supply chain. These are now becoming much more higher on all profiles. The engagement you had yesterday with the government institutions, probably wouldn't have happened a decade ago. But now sort of communities and societies, as well as us in the insurance world, are looking at how we have to deal with these really important risks. And I think, going back to your question about the role of the broker, the broker's role hasn't really changed. We sit there as advocates of clients. Our primary job is to drive solutions for clients. It's in order to sort of enable markets, enable insurers to be able to underwrite, but fundamentally it's to deliver the right solutions for our clients that are affordable, that they provide the right level of risk protection, and they are relevant to the risks they're facing. Insurance has always sort of suffered from the fact that it's looked in the rearview mirror most of the time to sort of make its decisions. And what the thing we've seen with the acceleration of the digital world we're now living in, that clients are grappling with real risks today and into the future. And that rearview mirror no longer really provides the sort of knowledge that we need in order to help clients design and implement the risk solutions they need as they go forward. So from a broker's perspective, we've got to be much more able to deliver insight to clients. And we're sitting on huge data lakes, but those data lakes are currently not really structured properly, not really sort of we're not able to interrogate them. And again, sort of the reference to the work that FERMA is trying to do on cyber with Lucy is a good example. The ability to really be able to pull that data out and be able to sort of deliver insight and knowledge across the market is going to be important. And we have to get the basics right as well. There's a reality around, we're living through a crisis that we've not sort of lived through in a generation. But the insurance industry, from a broking perspective and from an insurer perspective, still has to get the basics right.
What do you mean?
I mean delivering policies at inception, delivering claims, payments efficiently and fast. Those are the sorts of things that we've, as an industry, we've struggled with for a long time. And customers, are now used to ordering something on Amazon and getting it the next day. If they're getting their insurance policy in 3 months' time, is that really good enough? We're getting to the point where we've got the technology to do it and the ability to do it, and those are the things we need to get right. We get the basics right, it creates so much more time to actually focus on some of the issues that we're addressing today in terms of how we manage cyber risk, how we create the right journey for ESG, and that we don't sort of just end with knee-jerk reactions and short-term sort of positions being taken, which, as sort of Mario sort of indicated when he was talking around the kerosene example, we don't provide the support and underpin the community and the community that we want for the long term, and the insurance is seen as a real contributor to society as well as commerce.
Edgar, it's quite interesting to have your analysis of what the main challenges, I presume you share quite a lot of what we've heard already, but what are you doing to help your clients strengthen their resilience, which is the theme of our talks? Can you tell us about that?
Yeah, sure, and thank you, Alex. A lot of things have been said already, but I would like to start with some words quoted from Mario and Carlo before, and we heard a lot about complexity, about volatility, about uncertainty in this world. And this always brings me back to the VUCA world we're in. I guess everyone knows this abbreviation. Our world is about volatility, uncertainty, complexity, and ambiguity. And this was exactly what Carlo and Mario have described there. And I think this is also an important role for us as the insurance industry. Not only we as an insurer, but insurance industry means risk managers, of course, brokers, and insurers. And I think we have to deal with this situation. And how do you deal with this world? For me, very important, we need to be reliable and predictable. Because the more complex and the more uncertain the world around is, we need to be reliable and predictable. And that's very important for me personally, but also for us as HDI Global. And I think we can show the strength in there. And this also brings, I think, a very important part to the resilience you're asking for Alex. The second thing is that resilience, the question is, how do we define that? Do we define resilience for the industry, for each and every company? I think every company needs a high level of resilience. Yeah? And that means we need to cope with the changes in our world. And I think COVID has proven how volatile and uncertain the world is, because you said that 2 years ago we wouldn't have expected to have a hybrid format as we have now. Yeah? So actually, fortunately we adapted all very fast, but nonetheless, also technologies have to adapt. We have been talking about sustainability. Yeah? A lot of changes are going on, and this is where we have to deliver something which increases the resilience of our clients. Let me give you some examples. We heard from Mario, for example, about the technological shift of a lot of companies due to the environmental sustainability. And we as an insurance industry, we should follow and support this change. We have a technological change, so new risks are created, and I see this more as an opportunity than a downside. We should check what the new technologies are, what kind of risks are coming out of those technologies, and this is where we then have to jump in as brokers, risk managers, and insurers to protect those new risks. That's one part. The other part, we are talking a lot about cyber, but I think there are other things also behind cyber. When we talk about the Internet of Things, it's maybe a mixture of data collection, and cyber risk. We are talking even about the industrial Internet of Things. Yeah? And this is a technological change in technology we all see, and we also have to face this. We have to support this, and as an insurance industry, we have to find solutions how to protect our clients against the new created risks. And on the other hand side, we can use those data to increase again the resilience of companies, and we are doing that at HDI Global. We do a lot of research in respect of IoT, because we may start a shift, from repair and reimburse to predict and prevent. But we can't do that alone. We want and we must do that together with our clients, of course.
Okay, well, that's an interesting question to put to Xavier. The pandemic showed the need for collective action. What role do you believe that insurers play in this effort?
So I think that a lot has been covered already through Loïc, Edgar, or Paul. However, let's focus a little bit for 1 minute on the fact that climate change and pandemic have impacts that have changed and that are changing the society. That's clear. 40 million people have been affected by COVID in the EU. 800,000 people died from COVID. Last year, climate change has created claims or losses of more than $200 billion. That's 27% more than the previous years. So those are things which are changing. The world will never be the same. Well, we've said that already 10 years ago. We will still probably say that 10 years from now. But that's a reality. And the reality is that all this is changing, and it will keep on accelerating. Now, what is clear as well is that, as you rightly said, Alex, there cannot be a single answer from one part of the ecosystem. Insurers alone cannot cope with that sort of changes. Governments alone cannot cope with them. The only solution is clearly to cover those risks, to go for public-private partnerships in order to make sure that basically we collectively improve the overall resilience of the system. AXA has launched the AXA Future Risk Report very recently. You know, it's a report where we interview thousands of experts worldwide and so on. And it's very clear that what comes as a perception in 55% of the cases from the respondent, and I think that this is very important for us, is that the answer has to be collective. It cannot be a pure single answer to the topics. So governments, insurance companies, brokers, clients, risk managers, we need to work together and we need to find comprehensive systems that will change, in fact, the way to apprehend part of those risks. That does not mean that we are not doing anything. I mean, the insurance industry is already doing a lot of things. You know, we've launched as an industry, in fact, already quite a lot of activities. Last year, for instance, one syndicate in Lloyd's was created in order to cover the transportation of COVID-19 vaccines. So that's one of the elements that we are doing. There are many other different sort of, I would say, initiatives that are already existing, but not at a large scale yet. And this is what probably is important, in fact, to change now. It's the same in terms of climate. We have launched, AXA has launched with 7 other very large insurers and reinsurers, we have launched, in fact, the Net Zero Insurance Alliance. And the idea there is really to work together, to redefine our standards, to redefine the underwriting expectation that we are having, to help our customers better apprehend, in fact, their impact on the environment and how we can participate to finding solutions, going back to prevention, going to the management of claims and so on. So we are progressing on that front. We have initiatives that have been launched recently, which are gaining basically traction right now as we speak, but that still need, in fact, to deliver on a larger and a wider scale.
What kind of initiatives?
I've just mentioned, in fact, the Net Zero Insurance Alliance. So again, this one is emerging, so it's still something where we as a collective, again, 8 big insurance and reinsurance companies are working to try to define what we want to see in terms of changes on the way we apprehend risk and the way we underwrite risk. But I can take other examples. At AXA XL, for instance, we've designed last year with one of our big insurance customers in Italy. We've designed, in fact, and it's an insured that is active on the petrol front. So basically, we've worked together to link part of the program to the impact that they have on the biodiversity and so on. In France, with some brokers, we have launched, with Marsh, we have launched, in fact, also some elements and some programs whereby when a risk manager can demonstrate that their organization work on the biodiversity, they can get, in fact, some impact on their deductible, on their environment policies. So we have initiatives which are there. We have concrete initiatives which are there, but they need to gain traction. They need to be more structured, they need to be more organized, and they need to involve wider number of participants in order to really have an impact on the overall key elements, which are either, I would say, systemic risk or climate change elements, or ESG.
Thank you, Henning. It's always difficult to be the last one, but maybe it'd be interesting if your view, obviously, on the current state of the market, but if you also tell us what you see as the major risk trends.
Yeah, thank you. First of all, it's great to be here. And last year we had a pure virtual event. This year we've got this coming together already. It's like it's great to be here and have that physical event as well. So maybe I go a little bit into the details already where we are in the market and go on the back of what we heard from the risk managers as well. So clearly what 2020 showed us is that when we reflect a little bit on the situation, that obviously the losses we saw coming from COVID are still estimated around 100 billion of impact to the insurance industry. And when you look at what has been paid out and really reserved, it's clearly a much lower figure. So I think that's a very interesting one to figure out as well. Where are we for COVID and post-COVID related? We heard as well from our colleagues here that obviously nobody really sees that we are already in post-COVID environment. It's really still a prediction, and taking a crystal ball, what does that really mean? Because we are still in it, and the situation is still not 100% clear. What's also clear is that we went into the market already last year, pre-COVID, that the market hardened. and that we saw that as an impact. We also see in 2021 that there are a lot of natural catastrophes which are also driving exposures into the industry. So overall, it's an interesting one when you look at it from the perspective of what can we expect the market to do then going forward, and what are the really risks. So from my perspective, and what we as AGCS clearly see is that the importance of really being reliable to our clients was something which caused a lot of discussion over the last 12, 18 months. And this is clearly something where we as an industry have to learn that we become much better. On the other hand, we heard as well about sustainability, and sustainability means as well that we as an industry need to be sustainable, insurers need to be sustainable in terms of return to our shareholders. And I think this had been forgotten for quite a while, and the industry didn't really make money. I think that's when we talk about sustainability and being a reliable partner, that obviously means as well that the insurance industry needs to be able to produce a return in order to attract capital to basically provide capacity. I think that's as well something which is very important, and I think we all learned our lesson. And this is definitely something we are discussing at the moment with clients, with brokers. And what we clearly see is that the willingness to understand that, and the willingness to discuss that, and also the willingness from the client side to say, yes, there needs to be a sustainability and reliable partner, and we allow them to produce a return, is clearly there, which wasn't really there in the soft market. Where does that leave us in terms of the prediction of where the market goes? And again, that's a little bit of a crystal ball, and I don't want to be too predictive here, but there are a couple of very, very clear trends which we are seeing. So what's clear is that from a pure capacity perspective, to be very precise, we heard that before as well, is that on D&O insurance, there's clearly a capacity shrinkage, and there's not enough capacities, there's more demand from clients. We also see that on cyber, there's a lot of development in terms of capacity, and exposures are developing, and carriers are getting more cautious. And on the other hand, the demand for that capacity is increasing, and it's quite clear. And these are definitely areas which we as an industry, together with clients and carriers and brokers, really need to do our homeworks and find the right products and develop the right products. Couple of topics which have not been mentioned, which will drive the market as well, and also probably the environment, and what it means in terms of whether there is capacity or not. Social inflation has not been mentioned. I think social inflation related to liability risks in the US is clearly as well something which is a key driver, and we see that still increasing as well. Then inflation, general inflation, I think is a major topic we need to tackle. We see that everything becomes more costly, and if we insure business interruptions or property damage or other topics, it's clear that inflation is driving that as well. So that's as well an area to focus on. Then I mentioned cyber. Clearly, we will go in the discussion as well a little bit more into the details, but that is a driver of the market. And then lastly, climate change. We saw as well not only that pandemic is a risk for us. This year we were reminded as well through hurricanes in the US. We had the floods in Europe. We see more of these losses, and climate change clearly goes into the direction of, hey, this is alerting, and we need to tackle this risk as an industry. This all in combination will obviously lead to the fact that I don't foresee the market getting soon into a soft mode. I think there are emerging risks. There are a lot of risks which need to be tackled. It's more really a question for us not only discuss about price, but really about products and solutions. So that's in a short and brief what we are seeing in terms of market trends and major trends for the upcoming years.
Starting to understand a little bit more why Loic called it exciting. It's certainly the word which sums up all of your resumes of the situation. It's obviously a hard market situation. But a question from me, I don't know who'd like to ask this, but why are benefit clauses in case of a clear loss result not being shared with customers? Because you're all painting a picture of a kind of dramatic situation. So why are you not putting the cost for this simply on the people who pay for it?
Okay. I can start. I think, first of all, as it was explained, the market had to be corrected. And we are in the process to correct the market. It's not yet stable, but we are in a much better shape today than where we were 2 years ago. It was 15 years of soft market. It means that every year the price were down, the capacity, the requested capacity were bigger, and the coverage was larger. And we came to a point where it was impossible to make profit. And as you mentioned, the market, the insurance company were not sustainable, were at the risk to not be sustainable. So we had to correct this. Now, and I fully understand that it is a very complicated time for risk manager colleagues, and that's not an easy time to, and not an easy position to be today. Nevertheless, during this time and over the last 2 years, as always, at least for our clients, they continue to invest time and money to improve their risk. A massive amount of time. And I look at what our clients have done over the last 12 months. It's global, it's over the world, it's not only in my territory. But our clients have completed 50,000 loss prevention recommendations. And these 500,000 recommendations that has been completed led to about $700 billion of exposures that are mitigated. So it's a massive number. And this effort of our clients into risk improvement and to improve their risk has led, and they help us to, and they contribute to the positive loss trend for FM Global. And as a result of this, it has been decided, our board of directors has decided to deliver a membership credit, which is about $600 million of money that were credited to our policyholders. And so this is a way to recognize the profit and that the company is doing, profits that are above our targets, our objective, and it's a testimony of our mutual company, the mutual business model, and also of a shared belief with our insured that the majority of loss is preventable. So this is a way, and so some insurance companies are doing it.
No, I think Loic is right. Some insurance companies are doing it. Now we need, as Loic has mentioned, and it was mentioned previously, as an industry, we've not been a profitable investment for shareholders. We've not been profitable companies in the past, and not at the right levels. And the ecosystem needs insurance companies to be profitable over time. The other element is clearly about the fact that insurance, it's about mutualization. We mutualize risk, but as a consequence as well, if we start basically systematically giving profit sharing whenever there is no claims, then the mutualization principle cannot stand anymore. It's just mechanical and mathematical. Now, there are other ways. There are other ways to recognize the efforts which are being done. And I agree with Loic that our insured and the risk managers overall and the companies overall have not stand still during this period. They invest massively, they improve their risk, they do risk preventions, they implement risk preventions activities and measures and recommendations. This is seen in the way we allocate our capacity, the way we design our prices, and the way we design, in fact, the programs that we are looking at. But again, we need also to understand that the mutualization of the risk has an implication on the non-systematic allocation of a demutualization of profits. Otherwise, the system does not work. And if the system does not work, we have a massive sustainability issue.
I would like to support some of the things we heard before from the colleagues. Coming again from your question with the resilience, when we want to have insurance solutions which increase the resilience of our clients, of our companies, we as insurer also need to be resilient, means also need a financial strength. And for example, we at HDI Global, we have our target of return equity is 10%, which is far below the average of our clients. So it's not that we are trying to collect more money. It's just, I would say, reasonable to have also good rating finally. So what happens then? We have a cost ratio and a loss ratio, and those are the two pots coming out of supporting the insurance technical result. Of course, we are very much focused on the cost ratio, because cost is something we have to bring down, because no one wants to pay us for costs. And we have one of the lowest, and I think at HJ Global, the lowest cost ratio in the market. That's fully in focus, because cost ratio is a strong part of our combined ratio. The second thing is the loss ratio. And we're talking a lot about what happens, increasing prices, decreasing capacity, but sometimes I'm missing the why does this happen? Yeah? And we hear that from time to time. We heard that, Henning, you mentioned that social inflation. Yeah? Social inflation is a matter of fact. We had that in US, it started 4 or 5 years ago. Meanwhile, we have this in Europe. Yeah? Have a look to cyber. We have an increased number of cyber attacks coming from the large corporates, and meanwhile, let's say, a kind of industrialization of this industry going to the mid-market and to the smaller companies. Yeah? And this boosts the loss ratio, the number of losses. And the same with climate change. We all see the exponential increase of nat cat disasters. And let's have a look to Europe. Mid of July, we had one of the largest nat cat disaster ever. So we pay for that. And the question is, what can we do as a group? Where can we mitigate risks? And finally, the loss ratio is something what we are paid for. It's the mutualization, what you said, of risk. We have a collective of clients, and we just collect the risks, the money, and pay out the claims. That's what we are here for. Yeah?
I think it's important from my perspective to also say the importance of the fact that it's a competitive market, and the fact that certainly the dialogue I'm having now, having sort of seen a significant, probably I think we recorded 18 quarters of rating increase, and that sort of particularly accelerating towards the end of last year and into Q1 of this year. We're now sort of seeing that starting to moderate, and I'm not sort of suggesting we're moving into a softening market, but I am sort of seeing much more dialogue around growth and sort of insurers wanting to talk about it. We're seeing new capacity coming into the market, because it is a dynamic market, and certainly from a broker's perspective, it's our primary goal to create that competitive tension and to sort of bring new markets, access to new markets to clients. And I genuinely sort of see that on the horizon.
Henning, do you want to add something?
Yeah, so your question, to get back to that initial question, was very specific about profit commissions and sharing benefits. And I think from my perspective, it's clear that's a very specific deal-by-deal discussion as well, which can take place. But in general, I think very clear, to get back to your initial question, from my perspective, it's clear that first of all, the market needs to make money, to return some money, and build up basically what we've lost over the last couple of years, and then we should talk about, again, sharing benefits. But on a very specific deal-by-deal case basis, I think that still happens already and can happen, but I wouldn't see that as some broad-brushed solution on a wider basis. I think the time is not right for that.
You've all been mentioning cyber risks. Maybe a word on the new exclusions there are for cyber risks and how insurers and brokers are coping with those, because it's going to become more and more of a problem, obviously.
Yeah, so maybe I step in and start with that. I think that's what we heard. It's like, hey, that's an everlasting topic for us for quite a while now, and will be in the future. And obviously there's quite a lot which happened over the last 12, 18, 24 months in terms of the exposure. So what we clearly saw is that there was a massive rise in ransomware attacks over the last 12 months, which is clear that from our perspective, from a carrier's perspective, we need to do our homeworks in terms of like, hey, what is the aggregation risk here? What is the aggregation potential? So that we are not, again, looking back then retrospective and say, hey, we saw it coming, but we didn't do really something against it. So pandemic, we had the situation that there was a huge aggregation on that loss side, and nobody saw that coming. We should not be in the same situation for cyber that we say in a couple of years' time, hey, there was a massive attack which impacted a lot of our clients, and insurability is then not given anymore, and you've got this massive aggregation. And I think a lot of our carriers have that sort of exposure. We at Allianz, we clearly look into, first of all, to clearly understand what is that potential aggregation and really manage that. But I have to say as well, and I think that's right, we as an industry, we haven't really come up with that right solution for the future. What is really insurable, and what is the offer we can make to our clients to help them basically to mitigate that? And from my perspective, that can clearly be only on a per risk basis, i.e. on a solution which is not necessarily aggregating, because aggregation is basically that potential hurdle we will not be able to tackle.
Xavier, you want to add something to that?
Well, I think what is at stake here is, in fact, the industrialization of criminality. It's a crime industrialization. Mm-hmm. That's the first time this happens. Okay, we have had to face some crimes, but here, with cyber, it happens at scale, it's remote, and it can be industrialized. This is a very, very different sort of scenario that we never had. So we need to understand it. And as it was rightly mentioned, one of the big problems that could exist is if we do not understand what we are exposed to as insurers, but also what our customers, the insured, are exposed to. So what is very important today is not necessarily it's not only about to exclude, it's to identify. It's to make sure that we have a clear identification of the risk, a clear identification of what we want to cover, and then to design the right products to cover them. And those products need to include prevention and solutions. And the price is the adequation between the risk, the prevention, and the solution that we can provide. But here again, let's face it, we are in front of a crime industrialization pattern that is happening, and it's the first time it happened at this scale.
Anybody else on cyber?
Well, I think you've got to differentiate to an extent between what we're seeing in that sort of pure cyberspace, which Xavier has sort of referenced there, in terms of almost that sort of state-based threat. And I think clients would look at that in a very sort of different way than what they look at their risks that they see sort of cybernet, the Internet of Things, the industrialization of sort of systems, on their standard property programs and liability programs. And we don't want to get to a situation where we leave clients unprotected because of knee-jerk reactions. And it's beholden on us to provide the support for clients as they make the journey in terms of that risk identification and management process. We can't leave them exposed. And as we tiptoed as we went into...
It's very reassuring to hear you say that you can't leave your clients. But how near are we to being in that kind of panic situation?
We got very... you look at the sort of way that we sort of almost got vilified in the those early parts of the COVID crisis around our response to the pandemic, loss of communicable diseases, when we didn't become the banking industry of the global financial crisis, but there were moments when the insurance industry, you look at the press, it wasn't painted in the most positive light. And we have an incredibly important role to play in underpinning commerce, underpinning communities, and we need to sort of make sure we play that role.
Sustainability, I'm going to ask Mario and Carlo in a few minutes to come back on, but I would like, obviously we've been talking about sustainability, I would like to just press you all a little bit on how, I think it's quite interesting that we hear how you assess your clients as being sustainable.
Well, one of the things I would sort of say is it's very much sort of a moving, not a moving picture, but certainly one that sort of varies from client to client. And I was talking last night with Dirk from a financial institution's perspective. The risks that they run from a sustainability perspective are very different than the ones than Carlo and Mario articulated. And the lens that the insurers will look at it from a different classes. The D&O underwriters are looking at it from a sustainability perspective, very different than the physical damage insurers. So it is a very dynamic work at the moment, and certainly I think all the players in the market, and that's clients, brokers, insurers, are working their way through how they can actually be part of the transition and become enablers to sort of that transition, not to become blockers to it.
Anybody else want to take on the sustainability?
I like your word of transition, because that's where I see our responsibility as an industry. Yeah? It's not about pulling the plug and saying we don't want to insure any kind of car industry anymore. We have to follow the transition of our clients, of the entire industry. Yeah? And that means, on the one hand side, bringing down, for example, the carbon emissions, and at the same time, every of our clients starts to develop new technologies how to substitute carbon emissions. Yeah? And that's important for us to understand what kind of industries those, what kind of processes and technologies those are. And this is our responsibility to ensure this.
Anybody else want to make a comment about the definition?
Yeah, maybe one step as well, because in some of the lines of business we see it already, as you outlined in terms of D&O as example, and where that is happening already. I think what I can see in the market is that there will be a common standard, hopefully, in terms of performance indicators, which will help clients really to understand what needs to happen and carriers to have some sort of approach, because in the end, ESG is definitely a topic which can only be achieved together within the industry. And I think what we can't have is a heterogeneous picture and approach to that. So from my perspective, I think as well something which the industry needs to work together, and FERMA can be of utmost help, I think, as well to drive that, to really develop KPIs and performance indicators which can then be used going forward.
Nos deux amis français, un mot?
Yeah, maybe as a property underwriter, where I think we can add value is with the assessment of the impact of climate change for our clients. And I see three areas where we can give support: is to assess the risk, so to understand and to quantify the climate exposure for a client, to develop engineering-based solutions to protect them against flood, wind, hail, whatever. And also we can provide support in the way in the reporting requirements, legal requirements that our clients have to comply with in terms, for example, of annual reports. There is also a mindset that we need to keep in mind is when we erect a new building, we need to think about the lifespan of a new building. An industrial building, classic building, has a 30 years lifespan, typically. If we speak about high-rise building or heavy manufacturing location, we are more speaking about 100, even more lifespan. And we need to take into consideration the impact of climate change in the design of these new locations, because what a location that is today outside the flood zone can be tomorrow impacted by flood or another natural hazard. So I think it's a mindset that we should all have, and I believe that data. We spoke a lot about data. They are not a crystal ball. They are not. Everything is not in data, but it helps us to get more informed decisions.
It's very reassuring to know you think already we will be here in 100 years'
Yes.
time, because a lot of us are wondering if the planet will still survive.
Maybe not us.
We only have 12 minutes left, unfortunately. I'm sure you have some questions, but I'd like any reactions to what you've been hearing so far, Mario and Carlo?
Yeah, I have my first question is very, very interesting to hearing what you're saying. My first question is, what is today the value of your partnership with your client? Because it's very important, this issue, because I maintained stable panel of my insurer during all long time period of soft market, while you use it a lot, this term partnership, okay? In order, and I believe it, and I avoided to squeeze a lot in this market period, and avoiding to have opportunity to a speculative position, okay? Right now, the world is changing. I'm very happy to know from you what is now for you the value of a partnership, because we saw in the market that some insurers abandoned their historical client, stopped writing some line of risks. So,
well, this is just maybe one point from what's happening. It's a vast question. We have 10 minutes left because we have to finish on time. So I'd like brief answers to such a vast question. Who would like to give a Xavier?
Well, I think that partnerships is the essence of the relation that we have with our customers. It was in the past, it will be in the future. And again, it goes back to what we've been discussing today a lot. Dialogue, understanding, real understanding of where our insured and our partners are is absolutely essential. This is a long-term. It's a long-term dialogue. It's not a short-term one. Now, it's true, and you're right, Carlo, there are occasions where, because we have also to deliver the expected profitability that is there, we have to address part of the portfolio that were not appropriate. And this is painful. And this has happened. And I think that all insurers have faced, in fact, that sort of moments. But that does not mean that we don't value the partnership. Partnership, again, is absolutely essential. But we also need to be a sustainable partner. So we need also to address our points. Going back to what Edgar was mentioning, I think predictability is very important. Transparency is very important. So I think that those are clearly the key elements. We want to partner for the long period of time and for a longer period of time with our customers. This is specifically true because of the emerging risks which are there, where we need to collectively build resilience and build knowledge. We need to deliver transparency and predictability to you. So basically, you also understand what our constraints are. But I don't believe that we are in a world where we want to become transactional. At least certainly in AXA XL, this is not what we want. Mm-hmm.
Xavier, you've been the spokesperson for all of you. Any other things you'd like to add to reassure?
I think it's a great question. It's a fantastic question. I think we obviously need to take that question as well because, hey, over the last 24 months, it wasn't always easy, the negotiations and the relationship we had. But I would absolutely agree with what you said, what has been said in terms of the relationship. I think what's important really is that it should be a long-lasting relationship. And long-lasting means it's a give and take, and it's a strategic and ideally strategic relationship we can build and we should build. And it should not be a tactical one, opportunistic one, short-term, term-driven decision. So we clearly at Allianz look at our partnerships from that perspective, and we clearly distinct as well on that basis. Meanings like, hey, we understand quite well who of our clients have got a strategic interest to be with us together over the next couple of years, and who has been with us over the last couple of years. Also from a cross-class perspective, not only focused on one line of business. And you see that as well. And I can just share that over the last 18 months, our retention ratio, which we measure obviously in terms of who stays with us, was still quite high. So we know that we had to do things in terms of re-underwriting the book, and we were not always the easiest partner. And I think that's the same for my colleagues here on the table. But nevertheless, our retention ratio was still quite high, which means as well, hey, it's not only one-sided, and there is the view purely and clearly as well from the market. Yes, there needed to be a correction, and I think that's very important.
If I may jump in there only with the word, Alex, I'm looking. You're looking to the time. Carlo, thank you very much. Great question. The question is how can we prove this? What are the KPIs? How can we measure this? What a client relationship means? Yeah, and we as HA Global, we are coming from 120 years commercial industrial insurance, and I personally can't do anything else. So I also have a personal interest to continue doing commercial insurance. And it's my passion, and I love it. No, we will continue doing that, and the proof, as Henning said, for example, when you have a look to retention ratios, but also. Our philosophy is that we do not stop underwriting industries. We do not stop underwriting any kinds of lines of business. Yes, we have to talk about maybe some rates, shares, prices, the changing environment, but it's not that, let's say, in any kind of schematical way, we kick out countries, industry, regions, lines of business. And this is what I think is a long-term client relationship.
I'd just like to hand over to Mario, because I'm sure you have a few things that you've noted during the discussion. And what would you like to ask the panel?
Yes, I hear about interconnectivity of risks, and I think you can probably answer us about the interconnectivity of underwriting, of underwriters, because the reality is that certain risks, like casualty, what we are finding in the last years is that when you go to the renewal, they tell you, okay, cyber risk is excluded in your policy. So we ask, okay, and how do I cover this? Can I go to your cyber underwriter? And if you go to the cyber underwriter, he knows about the probability of a cyber attack, but he do not know about the impact of a cyber attack in liability. So I think the industry must make an effort to to link those underwriting lines to make sure that you can give us a solution, because it's very difficult to place your casualty program with an insurance company and the liability from a cyber risk attack in a different company. Imagine the case of a cyber attack to decide who's going to deal with the claim. And I think brokers have a very important thing to do here, because they see the global risk. But my question is, if you are trying to link or to interconnect those underwriters in your companies.
Yes.
Well, certainly, I totally agree, Mario. I think that that's sort of, you can't sort of divide it. You have to sort of, from a client perspective, look at the totality. And as I sort of referenced, I think when you look at what we're now labeling as silent cyber that we're seeing in core property and liability programs, you can't take the same approach that you take to those very defined cyber risks that we talk about in terms of the state-sponsored terrorism. And we have to sort of work to make sure that your programs are have the right level of protection across the board and are not just sort of isolated by a knee-jerk reaction to a word like cyber.
Yep. Any other conclusions? We have 4 minutes left for you to generally reassure Carlo and Mario and the others in the audience who've now seen questions.
So very specific to that cyber question, as I think as well as like, hey, we owe that, but it's in our own interest as carriers as well to do that basically and to interlink the various lines of business and coverages, because very clearly you see as well that if you look at some of the events which happened, if you combine first party and third party exposures, you can have as a carrier losses which are related to the same event from various different sources, various different products, various different lines of businesses. So it's in our own interest to interlink that. I'm not saying we are there yet. I think we need to do our homeworks, and I think the cyber topic will be one of the main topics as well for the years to come, to discuss what is the right product, what is insurable, what is not insurable. But clearly it's in our interest as well to interlink that, because otherwise we will not be getting a handle on the aggregation.
Mario, thank you very much. I also like your question. And I think that we can be better as an industry in that. Yeah, we always, of course, have the client focus and not only line of business per line of business, but of course, in general, we are here in industry when we talk about bigger companies that we are always looking for tailor-made solutions, and that's why we need conversation, as you said. Let's discuss the problems, and I think we're all facing some solutions there. Yeah.
But I think also that we cannot talk about long-term partnership if we do not apprehend the customers globally. And for us at AXA XL, this is the reason why we've decided to restructure our organization to create regions to get closer to our customers. So precisely to move from a line of business organization to a customer-focused organization where we talk, we engage locally with the customer on the broader topics. Obviously, we always have, in fact, the support of the lines of business because, as rightly mentioned, in fact, it has to be tailored. But it's also, we all collectively have different answers, but the answer that we are bringing at AXA XL is really to get closer to our markets, to get closer to our customers through a new organization that is focused on regions, in fact.
Yeah, and I truly believe in the partnership between the insurer and the client and the broker, and the teamwork to work together in order to have a better common understanding of the risk. If we have this common understanding of the risk, it will be more easier for us to understand your needs, to develop the capacity, the coverage, the price, and for you to explain within your organization what you need and why it is cost at this price. And by doing so, we can also work together, to develop your resilience. And by developing your resilience, we are developing our resilience as an insurance company, and we should be able to smoothen the variation of the market. So maybe it's an ideal word, but...
So I think that Mario and Carlo look a little bit reassured. I'm sure you had more questions, but unfortunately time is pressing us. But it was interesting to have this dialogue between both of you so that you interacted together. So if I take the conclusion of what you're saying, it's a closer partnership that you're suggesting and tailor-made solutions. When you have a surname like mine, it's always good to hear about tailor-made solutions. Anyway, thank you very much indeed. I'd like to say that if anybody's watching us and saying we didn't have a very diverse panel, we had a largely female panel yesterday, so you have to look at the things over the 2 days. Anyway, thank you very much indeed. We'll be here again live from Brussels at 2 o'clock Central European Time. I hope you'll be with us for our final session. A big round of applause here from Brussels. Have a very nice lunch. Bon appétit, and we'll see you at 2. Thank you so much to all of you. Gracias, grazie.